Welcome to our deep dive into the dark side of AI in the stock market. While AI has brought many advancements, it also comes with significant risks and challenges. Think of it like this. Remember that time you let your friend pick a stock based on a dream they had about a talking grapefruit? Now imagine that friend had access to the entire internet and could make trades faster than a hummingbird on Red Bull. That's AI in the stock market, and while it can be incredibly efficient, it also has the potential to go very, very wrong. Over the next few minutes, we're going to peel back the layers of this complex issue and expose the potential dangers lurking beneath the surface. Buckle up, because things are about to get weird.
Let's talk about spoofing, which sounds like something you'd find on the back shelf of an adult store, but is actually a very real and very illegal form of market manipulation. Spoofing involves placing large orders to buy or sell stocks with no intention of actually executing those trades. These fake orders create a false sense of supply and demand, tricking other traders into making decisions based on this misleading information. Essentially, AI algorithms can be programmed to flood the market with fake orders, driving up the price of a stock and creating the illusion of demand. These algorithms are designed to act quickly and can place and cancel orders in milliseconds, making it nearly impossible for human traders to keep up. Then, just when unsuspecting investors pile in, the AI pulls its orders, leaving everyone else holding the bag while it walks away with a tidy profit. This practice not only manipulates the market, but also erodes trust in the financial system, making it riskier for everyone involved. It's like tricking someone into buying a timeshare in a sinking swamp, except the swamp is the stock market, and the timeshare is your life savings. The victims are left with devalued stocks and significant financial losses, while the perpetrators walk away unscathed. And if that wasn't bad enough, we also have to worry about flash crashes, which are exactly what they sound like. Sudden, severe drops in the market caused by high-frequency trading algorithms gone haywire. These crashes can wipe out billions of dollars in market value in a matter of minutes, causing panic and uncertainty among investors. Imagine a room full of people trying to trade stocks, but instead of humans, it's a bunch of hyperactive robots making thousands of trades per second. These high-frequency trading algorithms are designed to exploit minute price differences, but when they malfunction, the results can be catastrophic. One wrong move, one glitch in the system, and the whole thing can spiral out of control faster than you can say margin call. The speed and complexity of these algorithms mean that once a flash crash starts, it can be incredibly difficult to stop. Regulators and market participants are often left scrambling to understand what happened and how to prevent it from happening again. The rise of AI and algorithmic trading has undoubtedly brought efficiency and liquidity to the markets, but it has also introduced new risks and challenges. As these technologies continue to evolve, it's crucial for regulators to stay ahead of the curve and implement safeguards to protect investors and maintain market integrity. Education and awareness are also key. Investors need to understand the potential pitfalls of algorithmic trading and be vigilant about the signs of market manipulation. By staying informed and cautious, we can navigate the complexities of modern financial markets and mitigate the risks posed by rogue algorithms. In the end, the goal is to create a fair and transparent market where all participants can trade with confidence. While the challenges are significant, they are not insurmountable. With the right combination of regulation, technology, and education, we can harness the power of AI for good and ensure that the markets remain a level playing field for everyone. So the next time you hear about robots going rogue in the stock market, remember that it's not just science fiction. It's a real and pressing issue that requires our attention and action. Together, we can build a safer and more resilient financial system for the future.
One of the biggest problems with AI in the stock market is the lack of transparency. These systems are designed to analyze vast amounts of data and make split-second decisions, but the way they arrive at those decisions is often a mystery. Many of these trading systems operate as black boxes, meaning their decision-making processes are shrouded in secrecy. Traders and analysts can see the inputs and the outputs, but the inner workings remain hidden. It's like asking your friend how they won the lottery, and they just shrug and mumble something about following the vibes. You get the sense that there's more to the story, but you're left in the dark. Sure, they might be telling the truth, but you'd be forgiven for thinking they sold their soul to a raccoon-worshipping cult for that winning ticket. The lack of clarity makes it hard to trust the system. This lack of transparency makes it incredibly difficult to assess risk. Investors and traders need to understand the potential pitfalls of their strategies, but with AI, the risks are often obscured. When an AI-driven trade goes wrong, it can be almost impossible to trace back and understand why. The algorithms are so complex and the data they process so vast that pinpointing the exact cause of an error is like finding a needle in a haystack. It's like trying to solve a crime where the only witness is a parrot that only speaks Klingon. You know the information is there, but it's in a language you can't understand. You know something shady is going on, but you can't quite put your finger on it. The lack of transparency in AI trading systems not only makes it hard to understand what went wrong, but also makes it difficult to improve the systems. Without knowing the cause of errors, developers can't make the necessary adjustments to prevent future mistakes. This opacity also raises ethical concerns. If we can't see how decisions are being made, how can we ensure that they're being made fairly and without bias? The potential for hidden biases in AI systems is a significant issue that needs to be addressed. As AI continues to play a larger role in the stock market, it's crucial that we find ways to make these systems more transparent. Only then can we fully trust and harness the power of AI in trading. The future of trading is undoubtedly intertwined with AI, but for it to be a future we can trust, transparency must be at the forefront. We need to demystify these black boxes and ensure that what happens in the algorithm doesn't just stay in the algorithm.
Now, let's talk about the elephant in the room, or should I say, the algorithm in the stock market. AI systems have access to vast amounts of data and processing power that would make even the most seasoned Wall Street veteran weep with envy. It's like giving a kid a calculator on a math test where everyone else has to use an abacus. Sure, it's technically allowed, but it doesn't exactly scream fair play. This creates a massive advantage for those who can afford to develop and deploy these technologies, further widening the gap between the haves and the have-nots. It's the financial equivalent of bringing a tank to a knife fight, except the tank is programmed to predict your next move, and the knife fight is for your retirement fund.
Imagine a world where everyone gets their financial advice from the same AI-powered chatbot. Sounds efficient, right? Now imagine that chatbot gets hacked to recommend investing in Beanie Babies filled with mayonnaise. Suddenly, everyone is rushing to buy up the world's supply of condiment-filled plush toys, and the global economy collapses faster than a poorly constructed Jenga tower. This is the danger of systemic risk. When everyone relies on similar AI models, the market becomes homogeneous, and a single error or anomaly can have catastrophic consequences. It's like putting all your eggs in one incredibly fragile AI-powered basket and then handing that basket to a monkey wearing a blindfold.
The rapid evolution of AI in the stock market has left regulators scrambling to keep up. The speed and complexity of these systems are unlike anything we've seen before, making it a daunting task for those trying to ensure fair play. It's like trying to catch a cheetah on a unicycle. It's not going well. The pace at which AI operates is so fast that human regulators are often left in the dust, struggling to understand and manage the implications of these advanced technologies. Existing regulations are often outdated and ill-equipped to deal with the complexities of algorithmic trading. These rules were designed for a different era, one where human traders made decisions based on intuition and experience, not algorithms processing millions of data points per second. Take front-running, for example, where an AI can detect and act on large orders before they're fully executed, essentially jumping the queue and profiting unfairly. This practice undermines the integrity of the market, creating an uneven playing field where only those with the most advanced technology can win. It's like cutting in line at the DMV, except instead of angry glares, you're met with the cold, calculating logic of an algorithm that's already spent your retirement fund on virtual Beanie Babies. This analogy highlights the absurdity and potential danger of allowing AI to operate without proper oversight. We need clear, comprehensive regulations that address the unique challenges posed by AI in the stock market. Policymakers must work closely with technologists to craft rules that are both effective and adaptable to the rapid pace of technological change. We need to ensure transparency, prevent market manipulation, and level the playing field for all investors. This means implementing systems that can monitor AI activity in real time and flag suspicious behavior before it causes harm. Otherwise, we risk creating a financial system that's rigged against us, controlled by algorithms we don't understand and can't control. The stakes are high, and the consequences of inaction could be severe, leading to a loss of trust in the financial markets and potentially triggering economic instability. Collaboration between regulators, technologists, and financial experts is crucial. By working together, we can develop a framework that not only keeps up with the pace of AI advancements, but also ensures that these technologies are used responsibly and ethically. The future of the stock market depends on our ability to adapt and innovate. With the right regulations and oversight, we can harness the power of AI to create a fairer, more efficient market that benefits everyone. But it will require vigilance, creativity, and a commitment to fairness from all stakeholders involved. In the end, teaching robots to play fair isn't just about technology. It's about ensuring that our financial systems reflect our values of fairness, transparency, and equality. It's a challenge we must rise to for the sake of our economy and the trust of all market participants.
While AI offers incredible tools for the stock market, it's crucial to address these dark aspects to ensure a fair and transparent financial system. Stay informed and stay vigilant. The future of finance is in our hands, and it's up to us to ensure that AI is used responsibly and ethically. Otherwise, we risk creating a financial system that benefits the few at the expense of the many, a system where the robots are calling the shots and we're left holding the empty bag. So, stay informed, ask questions, and demand transparency. The future of your financial well-being might just depend on it.